Well, Basel regulations started already in around 1988 because the purpose was actually twofold. The biggest purpose was to, on the one hand, create a level playing field for banks worldwide, and the second was to make sure that banks were stable enough to get through stressy situations when a lot of things at the same time go wrong, that they would be strong enough and that they would have a buffer to always perform their duties and support the economy. Well, the first version of Basel had a few defaults, and they were fixed in a later version that came out around 1992. But then you had the global crisis, so it was obvious that it wasn't enough because banks went bankrupt all over the world and got into trouble. So they looked at the Basel framework to see what can we do to fix this. And one of the reasons was that the banks had way too much lenience, way too much possibilities to create their own models. And the two purposes of Basel were not okay anymore because there was no level playing field. Banks that invested a lot in making their own models had lower capital requirements than the banks that could not do that investment. So it wasn't enough, and the level playing field was also gone. So that led to the fact that they needed a new framework, a better framework, and that is then the Basel 3.1 or the Basel 4 as we call it in Europe. Well, when you issue a bank guarantee or a letter of credit as a bank, that's actually not an asset yet, it's a contingent liability. When you issue a bank guarantee, there's no way, it's not sure that you will ever have to pay. In most cases, you will never have to pay at all. But you have to be prepared for the moment that you should be paying. If it goes wrong, then you need to pay. So to be prepared for that, you would still have to have capital aside. And under Basel 3.1 or Basel 4, which is now coming out, that liability, the way it is converted into an on-balance item, the contingent liability, that's the credit conversion factor. And the way that is modeled now is way worse. So banks and their customers will have to pay more, set more capital aside for something that is really, really low risk, because trade finance is low risk, and that is proven by data for over 25 years.